Hi, welcome. Good afternoon. Today we'll be speaking on the topic of stable value and new considerations for planned fiduciaries, brought to you by Portfolio Evaluations. Today's speaker, Marcia Peters, Chief Investment Officer at PEI, will lead us through the conversation. The session will be recorded and will be available for distribution after the presentation. You are in listen-only mode. However, we do encourage that you send questions via the chat box on the bottom of your screen throughout the presentation. And with that, here's Marcia.
Thank you, Brooke. Welcome to everyone participating in our call today. As Brooke said, our topic is stable value and new considerations for planned fiduciaries. Today's discussion is an important one and one that I'm sure you'll find very interesting. As a plan sponsor, you may have a stable value fund in your investment lineup, so you are aware that stable value funds are often viewed as the safest asset class in a portfolio, and they are often compared to money market funds. However, you also know that stable value funds are more complex than money market funds. Both asset classes are certainly valid, but stable value does offer different opportunities to participants. There are some special considerations that you need to be aware of when evaluating and monitoring a stable value fund, and clearly the events of 2008 drove home that point. If you're like our clients that had stable value funds and received quarterly updates, you probably saw that in the fourth quarter of 2008, the market value to book value ratio of your stable value fund dropped. They were probably around 102 or 103 and dropped to levels in the order of maybe 92 to 95. Most plan sponsors were surprised by this volatility of the market value, but on further analysis, especially in the months that followed, plan sponsors began to better understand the complexities, especially with regards to the variability of holdings in stable value funds. Participants, I should also have also taken by surprise, and with discussions with the plan sponsor, this led plan sponsors to really question the need for stable value and really ask us questions as to the viability of this asset class. Our view at PEI is that stable value funds can be a good and safe investment. However, we do acknowledge that the asset class can be misunderstood. And I also should add, we recognize that a plan sponsor needs to be comfortable with this asset class, and they need to understand the complexities. Our view is that if a plan sponsor understands the appropriate parameters that you need to select and monitor a fund, they will be able to better discover the opportunities that exist in this asset class. So my goal for the rest of this presentation is to help you understand this asset class and to determine if stable value is a good option for your investment lineup. So to accomplish this goal, I'm going to be reviewing the background and performance of stable value, how you can evaluate a stable value fund, and then we'll talk a little bit about some of the key issues in the industry. Stable value funds are structured around the core principles of capital preservation, stable income, and liquidity. As I said earlier, stable value funds are not money market funds, but rather they are a short duration fixed income portfolio. So the key elements of the structure, as in any fixed income structure, exist. However, this structure is wrapped with an insurance contract that really gets to the heart of these core principles. The first item is that the wrap contract really provides for book value payments to participants under most withdrawal situations. The second is that the wrap provides a stable return and that daily liquidity. The wrap contract, I should add, allows for amortization of gains and losses on that underlying portfolio, and that's really the essence of the stable returns. Let's take a look at this next slide, slide 7. On this slide, I show historical performance of stable value compared to money market performance. The red line is stable value, and the blue line is the T-bill rate. There's two noteworthy features that are highlighted on this graph. The first is that, as you can see, stable value performance has been much less volatile than money market performance. And the second key point is that the stable value has outperformed money market on the order of 150 to 300 basis points over this 20-year period. It's that combination of the higher returns and the stable income that's attracted both plan sponsors and participants to the stable value. However, let me add that these benefits, like with most investments, these benefits don't come without some risks, and those risks are from the structure of the stable value fund. In 2006, portfolio evaluations began providing detailed information about the structure of stable value funds to our clients to help them better understand the nuances and complexities of the fund. Some told us that was overkill, but I have to say by the end of 2008, our plan sponsors and even some of the wrap contract providers began to realize that stable value was definitely not a select and forget about asset class. This is because the stable value fund structure can vary. The holdings can be very conservative and can include short duration, money market, government, agency securities, but the structure can also include much longer dated, less liquid, even unrated and private securities, as well as structured securities. It's these type of securities that really provide those higher returns to the fund, but again, they are also the elements that create those more extreme swings, especially during periods of market stress like we saw in 2008. So the unique feature of the stable value fund really is this balance between the safety and the yield. So as a result, it's important for plan fiduciaries to understand the type of portfolio they're looking at, how it's structured, and all the potential risks that exist in the portfolio, not only when they're selecting a fund, but even on an ongoing basis when they're evaluating a fund. As I said, we at PEI have been dissecting and evaluating stable value funds really in depth since about 2006, and our clients really did appreciate that insight following the events of 2008. And I'd like to just, if anything, suggest to you that as you're reviewing your stable value fund with your advisor, request a more detailed and in-depth analysis about the structure. This next slide lists some of the elements that I'll review with you with regards to the stable value fund. And these are the elements that when you are reviewing them with your advisor, discuss these elements. They are the liquidity, the credit quality, the diversification, and risk management of the portfolio. Again, remember, stable value is a fixed income portfolio, so the considerations of a fixed income fund really apply to stable value funds as well. Let me take a couple of minutes. I'll talk about each one of these in a little detail. With regards to liquidity, you want to ensure that a fund has sufficient liquidity in order to meet those daily participant withdrawals. Typically, the better managed funds have about 10% cash or short-term instruments. However, it really is acceptable to have some longer dated, less liquid holdings in the portfolio because, again, that is what gives the portfolio its added yield. Too much, though, too many long dated or illiquid holdings, and I'm talking about numbers like 40, 50%, really are going to start adding more volatility to the portfolio. Turning to the credit quality, portfolios typically are investment grade, and that is important because that insurance wrap contract may not protect against defaults. Again, it's acceptable to have some high-yielding, possibly even unrated securities, maybe on the order of 5 to 10%, because, again, that's what boosts the return. But, again, it is also what adds to the risk. And when you start going in higher percentages, clearly you'll see situations where under market stress, market scenarios like 2008, you're going to see market-to-book value dip below par. Diversification is an important characteristic with all fixed income portfolios, but you don't not only to pay attention to the diversification of the holdings, the maturity, the credit quality, but in stable value, you also want to look to the diversification of wrap contract providers, the number of wrap contract providers, and the type of wrap contract providers, which can be either banks or insurance companies. And lastly, ask questions about a stable value fund manager's ability to manage the risk of the portfolio. Ask the manager how they assess risk, the types of tools they use, and their ability to stress test the portfolio. In particular, you want to understand how they evaluate cash flow needs, especially under different market scenarios. Let me spend a couple of minutes to discuss the wrap contract in a little bit more detail because there are some special issues associated with it. To kind of explain the wrap contract in a little different way, think of the wrap contract as a safety net on the fund. It does two things, as I mentioned earlier. It provides that stable income, and it protects against the return of principal. Wrap contracts, though, have come under a lot of scrutiny lately, in particular because, as you're probably aware, many of the bank providers have exited the wrap market due to the complexities of stable value funds, and also due in part to the increased regulatory requirements on bank capital. Unfortunately, this lack of wrap capacity in the market has led to some notable stable value fund closures. The good news is there are some signs that this situation is reversing. However, I still think it's important that you want to understand your stable value structure. To understand it better, there really are two key components that you should be aware of when you're evaluating the fund. The first is the exit clause. As I mentioned earlier, participants have daily book value liquidity. But when plans have a plan-wide withdrawal, they're usually subject to a waiting period, and that waiting period can be anywhere from 12 to 36 months. It's referred to as an exit clause. Now, this exit clause does not have to be exercised, if you will, when the market value is greater than the book value. But in situations like 2008 and 2009, when market value was less than book value, most plan sponsors that wanted to exit their plan had to wait that full time limit for withdrawal. So it's important to understand what your exit clause is, especially if you anticipate somewhere down the road there being a plan-wide withdrawal, whether it be due to a corporate restructuring or even something such as wanting to change your vendor or even your fund manager. The second important element of the wrap structure that gets some attention these days are the indirect fees. I'm sure all of you plan sponsors are well aware of the direct management fees on these funds as well as any fund that's in your lineup. But do you really understand or know the indirect fees associated, in particular with your stable value fund and associated with that wrap contract? Now, I should add the indirect fees are not things that plan sponsors pay, but rather are taken out of the return that participants receive. But typically, those indirect wrap contract fees are in the order of 20 to 25 basis points. Historically, they were very difficult to obtain that information, and I know when we were questioning back in 2006, we had a very difficult time getting that information. But over the last, in particular, we've noticed over the last year or two, fund managers have become much more willing to share that information and have been much more transparent with regards to fees. So definitely ask the questions about indirect fees, and you can use that as a basis of evaluating your fund as well as comparing one fund to another. I've discussed some of the issues in stable value that plan sponsors are thinking about, but let's look ahead a little bit and talk about a couple of other concerns that are going on in the stable value industry. While stable value has been successful in meeting all of these industry challenges to date, I think it's still important that you understand how plan sponsors are addressing, especially some of these key issues looking to the future. I know here at PEI we engage in an ongoing dialogue with fund managers, and we discuss these issues, in particular some of these concerns at length with our managers. And so I'd like to take a little time to share with you some of that information we've learned that's come out of those discussions. One of the questions we've asked stable value fund managers is, what is really the outlook for the wrap contract market? As I mentioned previously, wrap contract providers are declining. Some are exiting the market. Some are constraining their capacity. And it all is around the concerns about managing the risks in the portfolio and their questions about what kind of risk portfolio managers are putting into portfolios. Unfortunately, it's caused some funds to rethink whether they want to be in the stable value business, but for the most part, it really has caused stable value fund managers to become much more transparent with regards to their holdings and their investment strategy. And that transparency has now allowed them to enter into partnerships with wrap providers. Now these partnerships can take different formats, in some cases they may allow the wrap provider to dictate the terms of the structure in terms of the type of holdings that can be placed into the fund. Or in some cases, they will actually allow the wrap contract provider to act as a sub-advisor on the portfolio. All these things are in an effort to really increase the comfort level so that wrap providers will be more willing to offer wrap capacity, especially in the future. The second issue that is on a lot of people's minds these days are really the outlook for interest rates. And with current rates at historic lows, fortunately, stable value funds still offer a 200 to 250 basis point margin over money market funds. But the concern is that if rates were to rise and, looking out maybe a year or two, if short-term rates were to go up 150, let's say, or 300 basis points, there's really a question of how funds are going to manage around that. In our discussions with fund managers, they have spoken to ways they're building more flexible structures in anticipation of that interest rate scenario. And these flexible structures can be things such as shortening the duration of the portfolio, or buying variable rate securities, or even partitioning the portfolio in various maturity or liquidity buckets, or we've even seen some funds partition their portfolios in active buckets versus more laddered maturity or safety buckets. So all this work that they're doing is really in an effort to take advantage of the scenario when interest rates rise. So overall, the basis of the discussion, talking about these couple of concerns, at PEI we feel managers are really thinking about these issues. They're really being proactive and working towards solving these issues. And I would encourage you, as you're talking to your stable value manager or evaluating a stable value fund, you ask not only questions about the structure that we talked about previously, but ask some of these questions about the issues potentially looking forward, and find out how your stable value fund manager really is thinking through these issues and how they're addressing them. So what can you do next? The chart on slide 12 is a checklist for plan sponsors to help them evaluate their stable value fund. I've touched on some of these topics today. This checklist is actually from an article I wrote that goes into this topic in more detail. But let me just briefly touch on a couple of these points that you want to consider when selecting or even reviewing your existing stable value manager. First and foremost, you want to determine the type of stable value investment that works best for your plan. And tied to that is in thinking about the cash flow needs of your participants and how your participants may react under different market situations. Another point is you want to review that stable value funds manager experience managing fixed income portfolios, especially their experience in the past with managing interest rate risk. Some stable value managers have been money market fund managers, and some stable value fund managers have been fixed income portfolio managers, and you just want to get at their experience in really straddling both of those worlds. Along the lines we've talked about in detail already has been understanding the structure, the credit quality, the liquidity, the holdings. That's all very important. But you also may want to ask them some questions about the history of their market-to-book value, especially through 2008, 2009. It'll be very interesting to hear what their market-to-book value did during that time period, and it's going to give you some insight into not only what their structure looked like historically, because it may look very different today than it looked then, but also how they manage. In other words, how did they recover from that time period? This next point, the exit clause, we've talked about that, and clearly you want to understand any illiquidity that exists at the plan level. To the point of illiquidity, you also want to discuss any equity washable provisions. I didn't spend really any time talking about this, but if you were to offer what's called a competing fund, a money market fund or a short-term bond portfolio, also to your participants will most likely be restricted on their transfer between a stable value fund and one of those competing funds. And lastly, with like any investment, you want to examine the fees, not only the direct management fees, but the indirect fees associated, in particular with the wrap contract or any sub-advisory relationship. So I welcome you to visit our website to learn not only more about portfolio evaluations, but you can download a copy of this paper. It's entitled Revisiting Stable Value, and it was written in November 2011. Brooke, I think at this point I'd like to open up our discussion to some questions, so let me turn it over to you.
Great, thank you, Marcia. And I noticed some of you have utilized the chat feature. And just to say one more time that, yes, a copy of the presentation will be available upon conclusion of today's webinar. You can also find a link to the presentation will be posted on our website, which is www.porteval.com. Marcia, one of the questions that came in goes into the 2006. Says, can you explain the performance of stable value funds in 2006? It looks like money market funds may have outperformed stable value.
Yes, sure. Let's go back to slide number 7 and take a look at the performance at that time. Here we go. If you look at really the periods of 2003 to 2006, and even similarly in 1996, in both of those scenarios, money market rates rose, and stable value, by virtue of that smoothing element in the wrap contract, responded at a slower rate. The lag time was about 6 to 12 months. However, in both of those cases, money market rates did not cross stable value rates, as you can see from this chart. It's kind of actually interesting that we're looking at this chart because the 2003 to 2006 time period really is a good comparison as we think about looking forward. During that time period, 3-month rates rose probably around, looks to be about 400 basis points. And going into that cycle, stable value enjoyed maybe a 300 basis point yield advantage. So you can see over that 3-year time period, the yield advantage between stable value and money market rates compressed almost to 0. However, the rates weren't surpassed, and stable value spreads eventually recovered. I know in the conversations that we've had with stable value managers, they've actually pointed to that time period and feel as though, especially the managers who were there, and most of them were there during that time period, they really believe that looking forward, not only do they have the experience of 2003 to 2006 to take with them forward, but now they're even taking more steps to be able to respond accordingly.
Okay, one other question, Marcia, is will we continue to see stable value funds close? Are there still good enough funds available for plans out there?
Yes, we've seen a few notable fund closures over the last 12 or 24 months. And just this month, I believe we've received announcement of another fund closure. So it's still possible that there will be an occasional closure going forward. However, I have to say, stable value money is still continuing to move into the better managed funds, and those funds continue to secure wrap capacity from insurance companies. So I think there's still enough opportunities, especially if a plan sponsor can choose a separate account structure over a pooled structure. One question that occurs to me as I'm talking, I should raise, that we get this often from our clients, and they ask the question that is, if interest rates are going to rise, should I consider adding a money market fund to my investment lineup? And one thing I'd like to say about that is really the primary hurdle is not so much interest from an interest rate perspective, but it really is addressing more an administrative aspect of your current stable value fund. Many stable value funds don't allow competing funds like money market funds or short duration bond funds. They don't allow those funds to be offered. If they do, then participants are prohibited from reinvesting their withdrawals from 60 days into the money market fund. That's this equity wash rule application to stable value funds. It's that limitation that's generally the deterrent that keeps plan sponsors from considering adding money market funds to their lineup. And so I know in the scenario with our clients, while some of them have discussed that, they've basically spent more of their time and refocused more of their energy on understanding the quality of their existing stable value fund and seeing how that stable value fund is prepared for the future. And if need be, if they have to replace that fund, then they will do that. So that's where the focus has kind of shifted as opposed to trying to offer yet a competing fund or a money market fund.
Okay. Marcia, another question is, I understand that there is a new stable value structure that does not have a 12-month put. How does that work?
Yes, this is information we received recently as well. A notable asset manager will be modifying or has plans to modify their stable value structure to eliminate that exit clause or that 12-month put. However, they will still redeem. Participants will be able to obviously redeem at book value. However, any plan-wide event or plan-wide withdrawal is going to take place at market value, regardless if it's at book, less than book value. You can see that's an attractive option for a wrap contract provider to not have to worry about providing book value if market value of the portfolio is under the book value. And so for this manager in particular, it's encouraged wrap providers to give them more capacity. So that's a good thing from the manager's perspective. However, I think at this stage it's a little unclear how plan sponsors think about it and that possibility of not being able to get out if they have a plan-wide event to be able to get out at book value. So it remains to be seen, and we're still evaluating it ourselves.
Okay, great. Another question is it difficult to get detailed information from stable value managers, and does the extra efforts justify the cost?
Yes, I mentioned earlier when TEI started in 2006 to really provide much more in-depth analysis about stable value funds and managers. We had to ask a lot of questions of managers, very detailed questions about their structure, their holdings, their liquidity. And the funds really thought, this was overkill. But I have to tell you again, in 2008, 2009, our clients appreciated that analysis. The learning curve to analyze a stable value fund is steep, at least initially, but once you get the hang of it, it's really not that difficult. We touched on a lot of the topics, and if you take a look at our paper, you'll see it's really not that difficult. And I guess the one thing I would really say is that you only have to think about, and go back to that chart we showed earlier, and think about that spread. Over the last 3 years, typically that spread between stable value and money market funds has been 300 basis points. And so that extra work to analyze the fund really has earned your participants 300 basis points each year for the last 3 years. So I think it really is. I think the extra analysis is justified.
Okay, this is almost time to start wrapping up, so if you have any further questions, please submit them via the chat. But we do have one more here. It says, our plan stable value fund had a market-to-book value around 85 at one point. Now it is still less than par. Should we be concerned?
I would say, based on our experience, funds that had market-to-book values of 85 or even 88 back in 2008 probably had a very high percentage of liquid securities, maybe structured or mortgage-backed securities in their portfolio. And those securities were most likely fairly long-dated, and as a result, they haven't really even matured yet. And that's the reason why your market value is going to continue to lag. I would definitely suggest that you evaluate your stable value fund and question the manager about the holdings, in particular about the maturity and the liquidity and the credit quality, and really try to find out what they're doing to improve that book value in the portfolio. As I said, we've had ongoing dialogue really all along with our managers, and funds that were under even 90 or even that 90 to 95 really are back over 100, even in the 102 range. So there are plenty of managers out there who have been successful in turning around their portfolio. One last thing I should add is if you're in a pooled vehicle, you may want to question your stable value manager about withdrawals, especially in 2009 and 2010, because if there were large withdrawals when market values were suppressed, that's going to put pressure on the entire market value of the pool. So definitely another question you want to ask your stable value manager about.
And Marcia, there are no further questions this time.
Okay, good. All right, well then I guess just to briefly summarize, stable value funds, as our conversation has evolved here, we've discussed, are a much more complex asset class given the role they play in the investment lineup. However, please don't be deterred from adding stable value to your lineup. It just means that this asset class is going to require a bit more in-depth analysis. We generally feel if this asset class is better understood, any plan sponsor will be able to find opportunities in stable value and recognize that it can provide a safe and good investment for your participants. So at this time, let me thank you for your time. I really appreciate you giving us the time this afternoon. Please feel free to contact your PEI representative with any questions you have about this or any other topics. And please visit us at porterval.com. You can learn more about us as an organization. You can download the paper that I discussed. And as Brooke mentioned earlier, you can listen to a replay of this call. So again, thank you again for your time. I really appreciate it.
Great. Thank you.